Holy smokes, guys, it's really not looking good out there. We're absolutely getting wrecked in the markets right now. Every time I open my portfolio, it causes physical pain, but then I stop to remember that actually these are the moments that I've been waiting for so long now in the markets. And honestly, it's a time where we should all be excited. We should be and jumping up with joy because this is where the real profits are made in markets. Like, this is really the time to do it. And if you want to survive and actually profit long term, you have to be able to know how to handle moments like these, plain and simple. So in this video, that's what I really want to emphasize today. I just want to provide you guys a fresh and grounded perspective on how to profit, especially during times like these, because times like these in the market define a lot of your future success. So I want to make sure that you guys are well equipped to go through these hard times. And I know it's not easy, and that's why I think it's so important to talk about it. So that's why in this video, I want to cover 3 aspects that are going to be crucial to your success in the markets, which are going to be psychology, time, and liquidity. And then after that, we're going to be looking at which narratives we should be looking to in the markets and which top high quality stocks we should be looking to buy during this correction. So hopefully by the end of this video, you will leave feeling clear, confident, and ready to tackle this emotional and psychological battle that we call the markets, and hopefully come out victorious on the other side. So let's dive right in. So the first thing I want to talk about is psychology, but we're going to be using a little bit of history to put that in perspective. The first thing I want to point out is that every single market crash has been a buying opportunity. There has not been one time where this has not been the case. In the 2008 financial crisis, the S&P declined 57% over 17 months, but then fully recovered within 5 years. During the COVID-19 crash, the market dropped 35%, but then returned to previous highs within 5 months. So in history, there has never been a time where a correction or a crash is ever a bad thing. Let's just get that really clear. But even that being said, these times have been simultaneously the moments where people have lost the most amount of money. So why does that keep happening? It's because the markets are a war on our psyche. Literally, they are attacking our brains and our basic human nature. There was a study that showed that we feel much more pain when we see our money decline than when we actually see our money gain. The emotion that it creates when we see our portfolios go down 30 to 40% is much more painful or emotionally impactful than when a portfolio actually increases. So it's easy to say that you'll buy during a crash, but when it actually happens, most people freeze. And that is because it's attacking that psychological mechanism that we have, which creates fear, uncertainty, and doubt. And if you let that fear and uncertainty take over, it will keep you on the sideline forever and actually not make any moves. Successful investors don't react with emotion. They react to the opportunity. One key thing I've learned is that if you're feeling uncomfortable, it probably means it's a good time to buy. Because if you're feeling uncomfortable, it's highly likely that others are also feeling really uncomfortable, and we want to be doing what most people are not doing. So if you're able to take a step back and look at this from a larger time frame point of view, it actually helps you a lot to analyze the situation. And that brings me to my next point, which is simply time. The market has become so short-term thinking, it's crazy. Everything is quick, dopamine hits, and we get constant new information every hour. And now we're going to have 24/7 trading, which even further proves my point. The market is essentially reflecting the psychology of people, and that psychology has become so narrow-minded, reactive, and emotional, which has caused an extremely volatile market environment. And that market volatility that we would normally see in the markets is condensed into a shorter time frame. So what I'm trying to say is this: back then, maybe 20, 30 years ago, the markets were not reacting as quickly as they do now. So for example, let's take a 100% upswing and then a 50% downswing over the period of 2 years. Back then, that natural market psychology would play out over that term of 2 years. While compared to nowadays, maybe that same market psychology cycle would now happen in only 2 months instead of 2 years. Because again, the market has become so narrow-minded that people are thinking almost day to day, hour to hour. As compared to back then, that was not the case, and the markets would play out this volatility over a larger window because people weren't as reactive. Reactions to news and forecasts are really short-lived, and people are trapped into this very narrow line of thinking, and they always forget to take a step back. It's so important to understand and not get caught up in this because you don't want to be one of those people. Stop looking at your portfolio and updating it every second. Trust me, that's not healthy for you, and that only brings you more into this narrow line of thinking. Because really, over a larger period of time, things will be okay, and you need to understand that. So now that we have that perspective, how do we actually take advantage of it? This brings me to the third point, which is liquidity. One of the biggest mistakes you can make is just deploying your cash all in one time. Bear markets can honestly last way longer than we expect. So it's going to be crucial for you to have enough cash reserves so that you can deploy over a larger period of time. You should be spreading your buying over months to give you a chance to dollar cost average into your positions. Because like I said, if you think about these tips in a narrow-minded point of view, you're not going to do well because the markets can simply continue to go lower. Looking at 2022, for example, we had a whole year of just bear market. It was really bad. However, we've come such a long way since then, and people forget how much growth we've had. So these corrections are actually just fine. We have to welcome these corrections with open arms and not a narrow-minded line of thinking. But it's important to do it the right way. To dollar cost average appropriately, you don't go all in at once. You invest a fixed amount at regular intervals instead of trying to time the very bottom because that's simply impossible. This ensures that you're able to buy at different price levels. So if the stock keeps dropping, you're going to be able to pick that up at a cheaper price. So if you plan to invest, let's say $10,000, just do $1,000 every month for the next 10 months. You'll be surprised at how much more effective that can be. So the goal isn't to perfectly time the bottom, but rather it's to build positions calmly and maintain liquidity along the way. Not only is this the mathematically most effective way to do it, but it's also going to be so good for your own psychology because you're not going to have that whole entire sum of money invested at one time, and it'll actually be less of a burden for you to feel, which helps you to not sell and actually stick through the hard times. So now that you're able to take a step back, look at a larger time frame, understand your own psychology, and know how to dollar cost average, now let's look at actually what we should be buying during these times. It's extremely crucial that you're able to fully understand what it is that you're buying, because if you do not have conviction in the company and the growth story and why you are invested in the first place, it's going to be impossible to not sell and stick through with that investment long term. Because there will be more drama, there will be more ups and downs, and for you to be able to handle this volatility, you need to really believe in what it is that you're putting your money into. Because having a strong conviction will directly link to having good psychology. Both of those go hand in hand. The more confident and clear you are, the less struggle you will feel when encountering times like these in the markets. Because it's true, not everything is a good buy. You shouldn't just be buying anything and everything. We have to look for high quality stocks that have been beaten down past valuations that we don't agree with. We have to focus on companies with strong fundamentals and strong growth potentials because you have to be able to believe that story and have conviction in those stocks to actually be able to stick with them in the hard times. That's the most important part. And we can do this by focusing on the strong narratives first. So what you want to do is analyze the narrative and the story behind that narrative first, and then from a top-down level approach, go down to choose specific stocks. So let's take AI as an example, which is definitely a sector that we should be looking at for sure. AI is completely revolutionizing the industry, and demand for computing power is definitely skyrocketing. That's without a doubt. And we definitely have a long way to go. So with that being said, now you want to analyze the different sectors of that narrative. Because within the main topic of AI, there's individual pockets of aspects that contribute to the entire AI sector. So for example, one of those that I've talked about on this channel before are data centers. Because as AI grows, this is going to be a crucial part of running the whole infrastructure. Because massive amounts of data must be stored and processed, and that can only occur if we have enough data centers and the infrastructure to do that. So now that I've identified a narrative and a sub niche of that narrative, I will be looking at the best stocks that support that niche. And from here, you can do research on those companies to truly understand them at their core, their fundamentals, their financials, their growth story, and their valuation. Some stocks that I'm personally looking into are AMD, SMCI, VRT, and Nvidia. So to summarize, the markets are crashing, but we need to stay calm. Namaste. Every market correction is an opportunity, very plain and simple. A good investor will take a step back and look at this from a larger time frame point of view and not get sucked into that day-to-day reactive and emotional thinking. We have to welcome this opportunity with open arms, get analytical, and start looking at what you should be buying, and then begin deploying your capital on a dollar cost average basis. I'm personally slowly deploying capital into stronger opportunities that I believe have really strong fundamental, a really strong narrative, and growth story. There are some really high quality stocks that have gotten beat down a lot in the markets recently. You can check out all my other videos. I've talked about a few of them already. But like I said, at the end of the day, if you take anything from this video at all, it's this. A great investor will have a rock solid mental fortress. They will understand their own psychology and are able to take a step back from that as to not let that guide their decisions. And secondly, a great investor must have conviction. If you're going to invest your hard-earned capital into companies, you need to be damn sure that these companies are worth your hard-earned money. And none of this is financial advice. I'm just trying to make sure that you guys have control of your own financial future and that you have the best mindset you can to move through this market environment, because it's not easy, but I do believe that if you stick to these principles, you can succeed and you will succeed. I hope that you got a new and fresh perspective from this video today. But yeah, that's basically it for this video. I wish you guys all the best, and I'll see you in the next one.